All right, well, we begin this hour with the continued selling of the bond market as investors respond to more hawkish talk in the U.S. from Fed officials. We've seen new multi-year highs for the closely watched 10-year and 30-year treasuries stateside. Now, a reminder that when bonds go down, their yields go up. Those yields have been rising on the belief that interest rates will have to stay higher for longer, in part to contain inflation. Of course, that story has been even more complicated by that recent rally in oil prices we were just mentioning, and equities have ultimately been weaker of late on all of these developments, with worries that these higher interest rates will inevitably lead to a recession. Meanwhile, higher bond yields in the U.S. also complicate life here in Canada, where we know mortgage costs have already surged, stretching highly leveraged households. And our first guest this hour has some serious concerns about the health of Canada's housing-fueled economy. Philip Colmar is managing partner and global strategist at MRB Partners, and he joins us now. Philip, thanks very much for your time.
Thanks for having me.
Well, let's just start with the bond market itself and your interpretation of what's been going on.
Yeah, I mean, the bond market, or yields have been rising really across the G7, but it's being driven by resilience in the United States economy. So investors earlier this year and the Fed made the mistake to believe that interest rates had risen enough to create that knockout blow. They haven't. So now they're coming and capitulating to the idea that the economy is resilient, at least at this cost of capital. The Fed's revising up its growth forecast accordingly and signaling that it's going to be higher for longer interest rates. And at the same time, the bond market is unwinding what was a premature inversion of the yield curve as they bet on recession, starting to come back out. So we're seeing bond yields go up. It's fairly reflective of U.S. resilience, if you will. But as I heard you comment, unfortunately, it could be a lethal combination for Canada.
Why don't you explain why that is? Why does it matter what the bond yield picture in the U.S. ultimately, how does that ultimately impact, let's say, Canada's housing market?
So what's happening is bond yields across the G7 are coming up, including in Canada. So it's not only economic resilience in the United States, but it's global economic resilience. It also means that inflation won't come down as much as expected, particularly core services, ex-housing, those kind of things. So Canada's a price taker, and its cost of capital is reliant on the global cost of capital. So in other words, when bond yields go up abroad, it also drives up bond yields here. We're seeing it. The 5-year, which is linked to the mortgage market, is hitting new highs. So that's really the resilience. The problem is the resilience across the globe is why bond yields are going up. The problem in Canada is it's sitting on a massive bubble in terms of housing and household debt. And we've already seen a dramatic escalation in the number of homeowners that are unable to service that debt as they get reset to higher mortgage rates. And so we've seen the mortgage lenders reporting a huge number of mortgages with negative amortization now, which means they're not covering the interest payments and they're getting pushed out their mortgage maturities. So it's a real problem. The hope here is bond yields need to drop significantly, or mortgage rates do, in order so that wave of ongoing homeowners that are being reset to higher mortgage rates is at a lower rate than it is currently, and you don't continue to have those quasi delinquent mortgages, if you will.
So, Philip, just to connect the dots even further, for those who watch this mortgage story largely through central bank policy here in Canada, is the Bank of Canada done at this point with interest rates? If the economy showed signs of stress, particularly in the housing market, might they lower interest rates? Watching that is important, but you're saying equally you have to continue to watch what's happening in the bond market worldwide. That's going to keep some pressure on the costs of financing, let's say, your home.
Yeah, I mean, mortgages are also linked to short end. So the Bank of Canada could cut rates in that situation. And honestly, if the long end of the curve keeps going higher, it'll have to. I mean, let's be clear here. Mortgage lenders and policymakers prioritized growth in recent years at the expense of future economic and financial system stability. And at the moment, they're scrambling to be creative to prevent a full-blown housing bust. And they're praying, if you will, or banking on that interest rates will come lower to support the conditions and to bail out these new resets. Right now, mortgage or bond yields are going the opposite direction. And so instead of pushing out and providing more flexibility and pushing out that day reckoning, it's pulling it forward. That comes into the Bank of Canada, It's got to offset that ultimately. So yeah, it's done. But it's got some tough choices ahead of it because it's still dealing with inflation and those kind of things. But cutting rates could help that situation. But it needs to be complemented with other things like macroprudential measures and other things. Otherwise, you just stoke further imbalances. So it's got to be careful. Policy choices have narrowed in a lot because of the choices made in the past decade or two.
You talked about some economies in the world showing some resilience, and at times when we're looking at different pieces of data, people have characterized Canada's economy as being resilient. But you're highlighting this key difference, particularly with Canada's economy and all the household debt. You're a global strategist. If you're strategizing right now, where do you think Canada's economy is headed?
Well, the problem is when the cost of capital is going higher, so interest rates or bond yields going higher, you have to outline who's most sensitive or most vulnerable to it. Who's resilient to it, which is the US and Euro area. Who's most vulnerable to it, Canada, the UK, other types of developed markets that have housing excesses fall into that. And so Canada falls square right in the center of that. And so if bond yields keep rising higher, then what happens is that households soak up their discretionary incomes to try to service those debts. And so then they don't have the firepower to consume anymore. And the economy starts to weaken quite significantly. So it's on the vulnerable front edge of it. Now, the currency can help because if the world economy is stronger, and say the Bank of Canada is done or cuts and weakens the currency, through export channels, you can have some offset. But you're still trying to offset the household sector ability to spend. So yes, Canada's on the most vulnerable end of that front. If keep rising.
So, and just to summarize, and we showed for our television audience a board of some of your strategy ideas worldwide, and on that list we saw a note that says avoid markets that are vulnerable to higher interest rates, such as Canada. What is it that you would be avoiding? Investing, let's say, in the Canadian bond market? What is your Canada strategy, if you will?
Well, bond yields in Canada are going to go up with everything else. So yeah, so in other words, bonds would soften as yields go up. So that's one thing, but it's more in the risk asset spectrum. If bond yields go up and they do create that choking point for the Canadian housing, we do start to see contractionary tendencies or deflationary tendencies in house prices, and sort of what we saw, a taste of what we saw in the United States back in the late 2000s. If that's manifesting, or even the hint of it doing so, then what's going to take it on the chin will be the currency will weaken. This is the risk assets. The currency is going to weaken significantly, and the financials will get targeted by international investors. So they'll either pull out of the financials and reallocate their money elsewhere, or some hedge funds will take short positions on that. That's probably the front end of it, because you can't directly short housing. So that's kind of where it manifests itself. So I think that becomes vulnerable as long as bond yields rise. If bond yields start to subside here, then it gives a stay of execution to that. But I think as long as bond yields are rising, you got to be careful on those risk assets.
Okay, well.